We agree that over-familiarity impedes audit quality and independence to a certain extent. In the short run, this rotation could impair audit quality because the newcomers have to have the knowledge base and the training to be able to complete the audit work with the same quality as somebody who has been servicing before. This rotation, if you look at the magnitude and the timing with which it is going to come, it is bound to cause large scale disruption amongst the various companies, and this kind of large scale disruption is ill advised from the effects it could have on the corporate sector, especially when the Companies Act has mandated internal controls reporting and Ind AS is on the unveil. So whether the timing of this is appropriate is something which could be considered. Let's look at what happened across other countries as far as this rotation goes for us to have a flavor of what could happen. 30 countries require rotation in some form. Specific sectors or listed companies. India also has rotation in public sector, in banks, and specific areas wherein government investment is there. Who are all considering rotation now? India, US, and European Union. Brazil, China, Netherlands, Turkey recently adopted some form of rotation, some partial form of rotation. Those who reversed course, it's important to note, Spain, Pakistan, Turkey, Singapore, Slovak Republic, Czech Republic, Korea, and Latvia. Korea did this because of IFRS implementation, and Singapore did it because of the financial crisis. The European companies and banks have now come into an agreement to rotate auditors between 10 and 24 years. Corporate auditors would be changed after 10 years, and this tenure would be allowed to be extended if the company puts out a bid for an audit contract or they decide to hire one more firm for joint audit. While there was zeal to implement rotation across the globe, I think lessons need to be learned from all these legislation which have happened across the other countries to decide whether we are right in causing a large scale disruption. Because the rules, the act says listed companies and others as may be prescribed, whereas the rules say all companies other than almost 1% companies and very small companies. So therefore, there have been representations on this, but we are confident that rotation would come, and that would be one of the first and early notifications, and one has to see in what form it would finally shape. Disqualification of auditors. A body corporate other than LLP is disqualified. For a person, they have stipulated these conditions, not very different from the earlier one on fraud conviction. There are restrictions on business relationship, there are restrictions on engaging in non-audit services, or of course full-time employment or auditor of more than 20 companies. These are the various disqualifications which have been laid out. It is important that one has to take care that disqualifications don't happen by inadvertence, because it takes 20 years to build a reputation and 5 minutes to ruin it. The question on implementation, are these covered? When you talk about 1 lakh, they have given 3 conditions, whereas in today's scenario, securities and indebtedness could be any of these examples which are laid out. And business relationships, if I am the auditor of Apollo, can I not get admitted there? Are we talking at arm's length or normal course of business? Rules have tried to clarify some of this, but in terms of business relationship, vendor and business relationship, there isn't enough clarity. The representations which have gone out is that this should be treated in line with related party transactions. The way those are judged under the law, this should also be considered. So I think there is little more clarification which is required both on disqualification as well as on what kind of services to be offered, because the Act talks about only the proscribed services, and the definition of relative is so far and wide, and again relates to a position wherein there were joint families wherein you knew what the others were doing. Today you don't even have email contact with your own relatives, leave alone telephone. Nobody has the time to even see what your son or daughter is doing. And investments are all done with a split second that mistakes could happen. Unless you have a very vast system like what large organizations have got, that you have to put in your investments and then you would get a red blinking email saying you have invested in this and it's a restricted entity, dispose within 24 hours. How many organizations can afford that kind of a system by which you are monitored every minute time? So when we talk about such things as implementation of this provision on indebtedness and on relatives, one has to see whether we have the machinery to those people who have to implement this to be able to successfully implement these provisions. The Act brings about the proscribed services, as we call it under the SEC terminology. On non-audit services, the whole list is there. This restriction, it's important to note that it extends to holding and subsidiary companies. Associate companies are excluded in this. There is a transition provision given for 1 year for auditors to comply with this. Associate entities of the audit firm are also covered, and the board or audit committee requires approval for appointing firms only for the non-proscribed services. Friends, this is very common in organizations like ours where globally these laws are applicable, and therefore being an Indian arm of those firms, we all have these restrictions anyway, and the monitoring of the machinery for this is vast. So one has to really see how the medium and small firms could fall in line with all these requirements, because when they appoint auditors, we have large corporates, family owned, and like doctors, the auditor has somebody who has handheld the whole family business for years, and they would be their first confidence person. So for them to break away and appoint others, it's a question of confidence. It's just like looking for independent directors. To first create an awareness amongst those Indian business corporates to tell that the services are restricted, and then to move on and to engage others, is going to require a change in mindset. And the transition of 1 year, in our opinion, is too short for people to comply. We agree that is required for independence purposes, because we are used to day in and day out telling people, sorry, these services we cannot render. It's not only within India, even when people come from abroad, they ask you whether you can render all these services, and then they raise eyebrows saying, sorry, we can't keep your books and do the audit. So this is something which is common across the globe. Auditors' remuneration, simple. All expenses excludes remuneration for other services. My only question is, it includes the value of facilities extended. Price is what you pay and value is what you get. So are we going to land up in a perquisite valuation for guest house stay and for food offered to auditors, and then keep debating about the disclosure? Company secretaries, please note. Powers and duties of an auditor. If you don't understand it, you can't explain it, Kate said. Agree. When ISA 600 has not come to play, how can the auditor of the holding company have access to the records of subsidiaries and with respect to consolidated financial statements? The institute believes every chartered accountant is equal, and you cannot have access to their work papers. So does it mean that the auditor of the subsidiary would do his own audit, and the audit of the holding company, the auditor would walk in and do a re-audit to satisfy himself? Question mark. To report to central government on fraud, I think we will deal with it in greater detail. That's another aspect which we have to think about. Reporting requirements. Great questions make great reporting. I think that is the premise on which all these reporting requirements have been fostered upon the auditing profession. The auditor's report, the NAFRA, which is much talked about, could specify for certain companies the following provisions: whether they have adequate financial controls, have they failed to give information, and whether there are observations or comments to be made on financial matters. Additionally, the new reporting requirements, otherwise it's the same to 27(1)(a) and 4(a), excepting that the company's internal financial control systems in place and the operating effectiveness has to be commented upon by the auditor. The draft rules also prescribe 3 extra reporting requirements. 2 of them have already appeared in the CARO, and the provision for foreseeable losses has been included. Impact. Certain terms in this reporting requirement are quite wide. For instance, reporting on internal controls, we'll be looking at that. There's a lot of ambiguity in what is required. For instance, foreseeable losses, are we talking about accounting standard 7 only on construction contracts or any losses? And 2 provisions, as I said, have already been covered. Does it mean that the CARO will be repealed? On internal control, what are the responsibilities of auditors? They have to comment upon the adequacy, design and operating effectiveness of management controls, which means they have to conduct an integrated audit on financial reporting and internal controls. Unlike the Sarbanes-Oxley requirements, which covers only areas of internal controls relating to financial controls, this Act seems to have a larger definition of internal controls. It could be similar to SOX at best and not more than that, and that too, this kind of implementation and certification is feasible only for large companies. Look at the scope of what internal control means in general parlance and what is expected under these rules also. Policies, processes for efficient and orderly conduct of business, adherence to policies, safeguard of assets, prevention and detection of frauds and errors, accuracy and completeness, and timely preparation of financial statements. Compare it with the Sarbanes-Oxley requirements. That requires a management report on internal controls for financial reporting. We haven't seen a similar requirement excepting directors' responsibility. Internal control over financial reporting and assessment of risk of material weaknesses is very clearly stated in the Sarbanes-Oxley, and we don't find such clarity here. Policies and procedures which could be there in SOX are only limited to these 3 aspects which are on the slide. So question: implementation of Sarbanes-Oxley has caused great challenges even in advanced environments like the US, and something which is larger and wider in applicability on internal controls. How is the Indian corporate sector going to rise to this standard to meet it, and leave alone the auditors who have to comment on this? Challenges, literature and guidance, much more details need to be developed. I'm sure the ICAI should be working on something. Skills, training and accreditation. Friends, when we do audits under the PCOB requirements, all of us require accreditation for continuous training in addition to whatever education we have had. And if you don't have that accreditation, and if you don't serve such clients for a minimum number of hours of say 100 or 200 hours a year, you're not qualified to do that audit. With this large scale rotation and with the lack of internal guidance and the recognition of our own institute's training under the PCOB standards, how are we going to get people who are accredited to do this kind of work? What is the curriculum you are going to give to professionals to make sure that they get accredited? How are we going to satisfy regulatory inspections and oversight? Based on the US experience, it is an onerous responsibility first on management and then on auditors. Here we seem to have reversed the roles. And when will the rules be clear and get laid down before this gets implemented? Sri Priya spoke about revision on financial statements. These are the various steps which the auditor is expected to follow according to the rules when a revision of financial statements takes place. I'm sure the whole revision provision would have been covered under accounting and other sessions. This is just the role of the auditors. You can take a second to read through it. Why does the auditor have to step into the company secretary's shoes to ensure distribution of the revised auditor's report and financial statements to everybody who has received it before? I'm not able to find an answer. And why this bold and beautiful story when there is already a requirement under the auditing standards to say what should be in bold and what should look beautiful? I don't know why the Act suddenly steps into the auditing standards role and talks about something which has to be in bold. Let's look at applied in the case of reporting for fraud. You have to report to central